Welcome back, my friends. The news today is that Berkshire bought back about $2.3 billion in stock. Berkshire Hathaway bought back about $203 billion in stock in the first quarter through March 6th, based on a Barron's calculation from information in the company's proxy statement released late Friday. Berkshire is sitting on a record pile of cash. The market in general, meanwhile, is relatively expensive. Buying back stock lets the company put cash to work in a fairly priced asset it understands well. But before we get into all of that, I would like to thank everyone who views my videos. If you would like to support the channel, please see the link to Buy Me a Coffee in the video description below. And please hit the like button and leave me a comment below. I would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Berkshire Hathaway is buying back billions of dollars of its shares. Don't expect it to stop anytime soon. Warren Buffett has been very strategic when it comes to issuing or repurchasing Berkshire Hathaway. In 2010, for example, Berkshire issued billions of dollars in stock to fund the acquisition of railroad operator BNSF. It remains one of the only times Buffett decided to dilute shareholders. More recently, Berkshire has been buying back its own shares to the tune of billions of dollars each year. At times, the company has repurchased more than $7 billion in stock in a single quarter. During the past year, Berkshire has repurchased roughly $9 billion of its own stock. There are several reasons the company will likely repurchase even more shares in 2024 and beyond. Why is Berkshire repurchasing so much stock? Part of its motivation is that the company has too much cash. The company currently sits on a record cash pile of nearly $168 billion. If it remains invested, that cash earns a relatively paltry return for shareholders. Repurchasing stock allows the company to put that cash to work in something it knows and understands extremely well. The second reason Berkshire has been buying back stock, and will likely continue to do so, is that equity prices in general are relatively high. That's also likely the reason the company's cash balance is so high. There simply aren't many bargains left. The S&P 500, for example, currently has a price-to-earnings multiple of about 27.5, nearly 70% above its long-term average. The final reason Berkshire will continue to repurchase shares is that its own stock isn't that expensive. It currently trades at a price-to-book ratio of 153, right in line with its long-term average. The company is sitting on huge sums of cash, and its own stock is a relative bargain compared to the market, so why not repurchase shares? That's exactly what the company has been doing. Don't expect it to stop anytime soon. Warren Buffett's Berkshire Hathaway BRK-A BRK-B has released its 13F for the first quarter of 2024. The report indicates that Berkshire was a net seller of stocks last quarter. That's not surprising, given that stocks skyrocketed during the period. The Morningstar U.S. Market Index was up more than 10% during the first quarter. The big news in Berkshire's new 13F, insurer Chubb CB, is the mystery stock that Berkshire had been accumulating shares of beginning in the third quarter of 2023. By the end of the first quarter of 2024, the stock was among the top 10 holdings in Berkshire's portfolio. Several months ago, Morningstar strategist Gregory Warren explained why he thought Chubb might be the mystery stock. Berkshire Hathaway sold about 33.9 million shares of Bank of America for around $148 billion over multiple transactions this week, a regulatory filing showed. After the sale, Berkshire owned about 999 million BOF shares. Berkshire is one of the Charlotte, North Carolina-based lender's largest shareholder. The conglomerate owned by Warren Buffett began investing in Bank of America in 2011, purchasing $5 billion of preferred stock plus warrants to buy 700 million common shares, at a time many investors worried about the bank's capital needs. Berkshire Hathaway has been buying back its shares for several reasons. Undervaluation. Warren Buffett and Charlie Munger believe that the company's shares are trading below their intrinsic value. This makes buybacks a good investment for the company. Excess cash. Berkshire Hathaway has a significant amount of cash reserves. Instead of letting this cash sit idle, they are using it to buy back shares, which can provide a better return on investment. Shareholder value. Buybacks can increase the value of remaining shares by reducing the total number of shares outstanding. This can lead to higher earnings per share, EPS, and potentially boost the stock price. Confidence in the company. By buying back shares, Berkshire Hathaway signals confidence in its long-term prospects and financial health. Berkshire Hathaway's decision to initiate a share buyback is guided by a few key principles. Intrinsic value. Warren Buffett has stated that buybacks will only occur when the company's shares are trading below their intrinsic value. This means they believe the stock is undervalued and represents a good investment. Cash availability. The company ensures it has ample cash reserves to cover its operational needs and potential investment opportunities before committing to buybacks. Market conditions. They consider the overall market conditions and the company's financial health. If the market is volatile or the company's financial situation changes, they might adjust their buyback plans accordingly. Board approval. Any buyback plan must be approved by Berkshire Hathaway's board of directors, ensuring that it aligns with the company's long-term strategy and financial goals. These principles help ensure that buybacks are done in a way that maximizes shareholder value and maintains the company's financial stability. Warren Buffett evaluates intrinsic value using a combination of quantitative and qualitative factors. Here are some key elements he considers. Discounted cash flow, DCF, analysis. Buffett often uses DCF to estimate the present value of a company's future cash flows. This involves projecting the company's future earnings and discounting them back to their present value using an appropriate discount rate. Economic moat. He looks for companies with a sustainable competitive advantage or economic moat. This could be due to brand strength, cost advantages, network effects, or regulatory advantages. Management quality. Buffett places a high value on the quality and integrity of a company's management team. He prefers leaders who are capable, honest, and shareholder-friendly. Consistent earnings. Companies with a history of stable and growing earnings are more attractive to Buffett. He looks for businesses that can generate consistent profits over time. Return on equity, ROE. A high and consistent ROE is a positive indicator for Buffett. It shows how effectively a company is using shareholders' equity to generate profits. Debt levels. Buffett prefers companies with low levels of debt. High debt can be risky and reduce a company's financial flexibility. Industry position. The company's position within its industry is also important. Buffett favors market leaders with strong competitive positions. By combining these factors, Buffett aims to determine whether a company's stock is trading below its intrinsic value, making it a potentially good investment. Warren Buffett assesses management quality through several key criteria: integrity and trustworthiness. Buffett values honesty and ethical behavior. He looks for managers who are transparent, straightforward, and act in the best interests of shareholders. Track record. He examines the historical performance of the management team. Consistent success in growing the business and generating profits is a strong indicator of capable leadership. Capital allocation. Buffett pays close attention to how management allocates capital. Effective capital allocation involves reinvesting profits wisely, making prudent acquisitions, and returning capital to shareholders through dividends or buybacks when appropriate. Communication. Clear and honest communication with shareholders is crucial. Buffett appreciates managers who provide detailed and understandable reports and who are willing to discuss both successes and failures openly. Long-term focus. He prefers managers who prioritize long-term growth and sustainability over short-term gains. This includes making decisions that may not pay off immediately, but are beneficial in the long run. Alignment with shareholders. Buffett likes to see that management's interests are aligned with those of shareholders. This often means that managers have a significant personal investment in the company, ensuring they are motivated to enhance shareholder value. Operational efficiency. Effective management should demonstrate the ability to run the company efficiently, controlling costs while maintaining or improving quality and service. By evaluating these factors, Buffett aims to invest in companies led by managers who are not only skilled but also trustworthy and aligned with shareholder interests. But what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. And before we end, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions, doctors, including any type of specialty, nurses, and that includes all grades of nurses, lawyers, regardless of area of legal focus, teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So be sure to check out ProWorldNet.com if you are looking for a job or an employee. Thank you for watching.